Banks have outperformed this year. The KBW Bank Index is up 32% year to date versus about 18% for the broader S&P. Joining us now is Devin Ryan, senior research analyst at Citizens. You've got these massive runs, particularly in the big banks. I mean, Citigroup is up about 71%, finally trading above book value this year. Goldman Sachs up 58% this year. Morgan Stanley up 43%, or 45%, this year. You think they're expensive. You think they're going to get more expensive in 2026. So what do you do in that scenario? I mean, do you ride the wave up higher, or do you say, you know what, maybe this is the point in time where things are getting a little pricey. I'll just crystallize some gains and see what happens?
Great question. And I think there's a few ways that we can play this. Well, first off, I think we just step back and why are the stocks up so much? So business was pretty good in 2025. It's probably getting better in 2026 with capital markets still gaining momentum. I think the loan backdrop is getting better. And then deregulation and just the ability for banks to really utilize capital and generate better returns on that capital. And so I think those are trends that started in 2025 post-election. Those continue. But then, the big piece that we're talking about as well is just sector rotation and technicals. ETFs in financials saw about $30 billion of inflows last year. And we think that continues into 2026. So that's kind of the marginal buyer here. And that's why, Goldman's trading 6 turns above historical levels on PE in 2026. Morgan Stanley's 5 turns above. So we think that trade can continue, and actually the business momentum into 2026 is only accelerating. So we'd probably stay in some of these names, but then there's other places you can play. I think regional banks, we see opportunities there, and then kind of ancillary firms like Schwab, or even in some of our fintech coverage that are going to benefit from some of those same themes.
What do you think can ultimately derail it? What should investors be on the lookout for as it pertains to just the continuation of this theme? I mean, outside of the macro picture, which obviously that if that deteriorates, then the whole trade falls apart. But there are so many tailwinds here. What are some of the biggest risks?
Yeah, I think that the biggest one really is macro, as you just mentioned. But you remember back, not too long ago during Liberation Day, these were some of the worst performing stocks. So we've had kind of a 360 here, 180, really around kind of sentiment. But I think more broadly, we need to see a continuation of this capital markets recovery. Announced M&A volumes were up 40% in 2025, but that was really large deal driven. What we're looking for in 2026 is kind of a continuation and a broadening out, meaning financial sponsors re-engage. And I think that's going to be very good for banks, both in terms of capital markets activity, but also reigniting some of the lending activity. So we really need to see that play out. And then we need to see some of the benefits of deregulation come through. There's a lot of talk about it in 2025, but we need to start to see capital being reallocated internally. We need to see capital being released in return. So I think those are a couple big things that the market is banking on. If we don't get those, people would be pretty disappointed. But our call right now is that we're probably getting that. So the path of least resistance is still positive here.